Hello folks, Charlie Gipple here with CG Financial Group. Hey, I wanted to do a quick 5 or 6 minute video on this trade group meeting that I attended last week. So you consumers out there, those of you that are trying to invest and hopefully have a retirement of your dreams, to make sure you don't run out of money in retirement. If that is your goal, then you may find interest in this. So I was at a trade group meeting last week, and it was called Structured Retail Products. Structured Retail Products, which I know probably sounds absolutely sexy to everybody out there. But this is a global trade group. They're based out of London, and they had it in downtown Des Moines here at the Embassy Club. And they asked me to come in and speak to talk about indexed annuities. Structured notes, which is really what their job is as a structured retail product trade group. Structured notes, it is their job to make sure that these products proliferate across the globe. China, for instance, there's like $500 billion in American dollars, that is, versus China currency, that's written over in China in these types of products. So this is a big, important global trade group. But they had a lot of quants there, a lot of actuaries. Quants, and what I mean by that is people from investment banks. JP Morgan was there, actuarial types, the people that sell the hedges to insurance companies, that sell the hedges to hedge funds and private equity firms and all that stuff. So this is big money here, and this is Wall Street that was in downtown Des Moines. There were a lot of people in downtown Des Moines walking around with European accents last week. But anyway, and then I get up there with my slow Southern Iowa drawl, and it was interesting. But here is the point. Some very smart people, Wall Street types, stock and bond type folks, hedge funds, private equity funds. There were also some index providers, stocks, like the Euro Stocks 30, for instance. So there were also index providers there. This is Wall Street, the very core of Wall Street. Here is what's interesting is before I got up on stage, there was a head of a retail arm of one of those investment banks. So think of an investment bank. An investment bank has many different tentacles, right? One of those tentacles, in addition to buying and selling call options and put options and derivatives and futures contracts and all that, one of those units is retail advisors. So think of a financial advisor, a lot like myself. I work with retail consumers. But I'm an independent person. I work for myself. I don't work for anybody else. Well, this investment bank had an army of people like me that was on their payroll that were, in fact, employees of that company. So this guy had a pretty big job because he oversaw the insurance area of that retail arm in this big Wall Street firm. Here's what's interesting to me to get to my point about annuities. Annuities are important today. Indexed annuities are proliferating. This is going to be a $70 billion business by the end of 2019. These products, they just started back in 1995 and they've gone straight up. They especially go up in times of crisis like 2000 to 2002, 2007 to 2009. But I digress here. What he said was this. He says, who would have ever thought 10 years ago, looking forward to today, that when I look at my team and look at the sales of where my retail team, my insurance retail team, which is embedded inside an investment bank, who would have ever thought that indexed annuities today represent about 30% of the sales that we get every year now? Who would have, or at least will be this year, I shouldn't say every year, at least will be this year. He said, who would have ever thought that? To me, that was pretty important. But what he said was he took the words right out of my mouth. What I've been saying for years and years and years. He said, so 10 years ago, we wouldn't have even really approved these products. We wouldn't have even approved these products because it was all stocks and bonds and all that stuff. But then with these new iterations of the products that have come out, he said, here's what we realized. And looking at these products, these indexed annuities that have the insurance wrapper over them, meaning that longevity insurance, the guaranteed lifetime withdrawal benefits, that longevity protection, the fact that, hey, you still have your account value that's going to grow with whatever that index does in that given year. You can't lose your money if the market tanks 20%. But by the way, you can also take lifetime withdrawals because there's that longevity insurance wrapper over the top of it. But here's what he said. He said, what I have found is these products are doing things that cannot be replicated in the capital markets. He says what we have found is these products are doing things that cannot be replicated in the capital markets. Now that sounds like a really brainy investment banky type thing to say, right? But this is what I've been saying for about almost 2 decades now. You cannot replicate what it is that these insurance companies can do. Why is that? Let me give you an example here. There was an individual, another intellectual in the industry, a lot like some of these quants at this meeting last week. This guy's name is Moshe Milevsky, Moshemilevsky, Moshe Milevsky. You can look him up. He's very profound in the area of retirement planning. But what Moshe Milevsky said is, annuities, it's as simple as this. It's as simple as this. There are 5 95-year-olds sitting around a table. Let's say one of those 95-year-olds looks up and says, hey, we've been playing bingo here for years. Let's play something fun. Let's each put $100 out on the table. Put $100 out on the table, and that will create a pool. It'll create a pool, right? It'll create a pool the size of, well, $500. And here's the thing. Whoever is around a year from now, let's split that pool up. Well, a year goes by, and the mortality tables show that how many of these 96-year-olds will be around that year later? 4. The mortality tables say that one of them, unfortunately, will die, right? Those mortality tables don't know when you or I will die, but groups of thousands and hundreds of thousands, those mortality tables know exactly how many people are going to die, right? Well, these mortality tables say that there will be 4 of those 96-year-olds still around. So when they divide up that pool, what do each of them get? And by the way, they never even invested that money, right? Each of them get $125, right? Now, I'm not suggesting that annuities are going to give anybody a 25% return. My point is that pooling power is how people are able to, the people that pass away early are able to pay for those that live too long, which is the inverse of this product that was created back in 1706. 313 years ago, there was this insurance company, and this insurance company's name was the Amicable Society for a Perpetual Assurance Office. Amicable Society for a Perpetual Assurance Office. The first life insurance policy issued by this company was in 1706. Do you think there was a little skepticism in that year when this company came out and said, hey, you pay a premium today of whatever the currency was in London. This was in London. 313 years ago, this first policy issued. Do you think there was a little skepticism when that company said, hey, you pay us whatever the currency was, $100, let's say, you pay us that today, you get hit by a bus next week, and we will pay your beneficiaries thousands of dollars, maybe tens of thousands of dollars. Of course there was skepticism, right? How is that possible? How is that magic able to be created to where somebody gives a premium and then it just turns into thousands of dollars? Well, that's that magical pooling power of life insurance, right? And annuities are the inverse of that. And that is how annuities, those lifetime benefits, the lifetime income stream, that is how these insurance carriers are able to do things that cannot be replicated in the capital markets. I love securities. I talk a lot about securities in my practice, but I also like annuities. If you are of that age group to where you're starting to take the off-ramp into retirement, you know, kind of that red zone that Prudential coined a long time ago, somewhere around 10 years prior to retirement, 10 years prior to retirement, and then shortly after retirement. Those are the most important years to start to look to, not get hurt by certain risks like sequence of returns risk, which is a completely different topic. But anyway, annuities can do things that cannot be replicated in the capital markets. If you don't believe me, believe some quant with an investment bank that usually likes to talk about stocks and bonds and all that stuff. So anyway, I'm Charlie Gipple. I'm the CEO of CG Financial Group. It's about 7 o'clock on Tuesday night, and I'm home, and I think I'm going to get something to eat.